The U.S. market is currently closed. The last reported closing price for Nuburu Inc., BURU, on the NYSE American Exchange was $0.34 as of October 17, 2025, at 4 p.m. Eastern Time. This figure sits at the lower end of the day's range of $0.30 to $0.35, representing a minor dip from the previous session's close. Now, what's fascinating is that despite the recent flurry of highly optimistic press releases about strategic acquisitions and a significant business model shift, the stock price action remains stubbornly anchored in penny stock territory. Investors might be reading the headlines about the company's grand transformation plan and expecting a sustained breakout, but the market's subdued reaction, even after major announcements like the acquisition agreement for the Italian software firm Orbit and securing a large public offering, tells a much more nuanced and cautious story. The disconnect between the corporate narrative, which paints a picture of a defense tech powerhouse in the making, and the stock's persistent volatility and low valuation, is precisely where we need to focus our attention. The prevailing market belief around Nuburu right now is one of high-risk, high-reward speculation. For a long time, the company was known primarily as a blue laser technology firm, developing high-power, high-brightness lasers for demanding industrial applications like welding copper in electric vehicle batteries or metal 3D printing. However, the commercial traction simply hasn't materialized to support the initial high valuations. Revenue has been microscopic, and the losses have been substantial. This is the expectation, a struggling laser tech company with a niche but unproven product line. The reality, which few are taking the time to fully analyze, is that Nuburu is no longer primarily a laser company. It's a shell acquisition vehicle scrambling to morph into a defense and security technology integrator. The former identity, the blue laser technology, has now been repurposed to serve as an enabler for the newly established Nuburu Defense LLC. This is a fundamental change, and it introduces an entirely different set of risks and potential rewards than the pure-play laser business ever did. You shouldn't be looking at BURU as a machinery stock anymore. You need to see it as a defense and security speculation stock, and that shifts the entire analysis. Looking at the recent stock movement, the volatility is extreme, which is typical for a microcap undergoing such a radical corporate restructuring. In late September and early October of 2025, the stock experienced massive single-day swings, spiking over 29% and even 86% on news related to its strategic updates, including the announcement of a $12 million public offering and the implementation of a dual CEO structure designed to execute the defense-focused strategy. These are not movements driven by fundamental earnings reports or significant product sales. They are almost entirely news-driven spikes in anticipation of future acquisitions and defense contracts. The high trading volume, sometimes reaching into the hundreds of millions of shares, reflects a battle between retail traders jumping on the acquisition news and more cautious investors or institutional funds either taking profits on the spikes or shorting the speculative froth. The fact that the stock often retraces those gains just as quickly, as seen in the days following the initial surge, confirms that there is no sustained institutional conviction yet, just high-frequency trading and retail speculation chasing headlines. The 52-week trading range of $0.12 to nearly $1 shows the whiplash investors have experienced, highlighting that this is a stock moved by announcements, capital raises, and the associated dilution, not organic growth. The institutional activity data confirms this cautious stance. While there are a few institutional owners, their total reported share count is relatively small, and their overall portfolio allocation to BURU is negligible. Major index funds like Vanguard and Geode Capital Management hold shares, but this is often due to their mandate to passively track the total market or extended market, meaning their position isn't a strong conviction statement about the company's prospects. What's more telling is the filing history showing instances of institutions reducing or completely selling off their positions. The sheer size of the recent capital raises, like the $12 million public offering in September 2025, points to significant shareholder dilution, a major headwind that keeps the stock price suppressed. Every time the company issues more shares to fund its acquisition strategy, the value of the existing shares is diluted, counteracting the positive sentiment from the strategic news. It's a classic chicken and egg problem for small caps. They need to raise capital to execute their vision, but the act of raising it penalizes the stock price, trapping it in a cycle of speculative spikes followed by dilution-induced pullbacks. Let's ground this in the company's two contrasting business segments. Originally, Nuburu's core business was the development and manufacture of high-power, high-brightness blue lasers for material processing. Their technology is touted for welding reflective metals like copper and aluminum with superior speed and quality compared to traditional infrared lasers, a crucial need in sectors like e-mobility, EV battery manufacturing, and 3D printing. The product line includes lasers like the AO150 and the BL250. The core scientific advantage remains. Blue light is absorbed much better by these metals than other wavelengths, leading to more efficient processes. However, selling high-capital equipment into slow-to-adopt industries meant revenue struggled, dipping from a modest $2.09 million in 2023 to a dismal $152,127 in 2024, according to some figures. This commercial failure is the reason for the drastic shift in strategy. The new focus, the so-called Defense and Security Hub, is a wholly separate and financially distinct proposition. The company is actively pursuing acquisitions like Techne SPA and Orbit SRL to gain footholds in defense tech, military vehicle outfitting, electronic systems, and operational resilience software, SaaS. The plan is to leverage the blue laser IP in military and defense applications while simultaneously building a diversified defense tech integrator through M&A. The company estimates that the acquired businesses could contribute over $50 million in revenue in 2025, which, if achieved, would be a transformative increase from the laser business's current run rate. This massive expected revenue jump is the key expectation driving speculative interest. The reality, however, is that these acquisitions face considerable execution risk, regulatory hurdles, such as the Italian government's Golden Power notification process for the Techne deal, and the immense challenge of integrating disparate companies into a coherent, profitable entity. Furthermore, the NYSE American warning letter the company received in mid-October of 2025 for a disclosure violation, though quickly resolved, highlights the organizational strain and compliance risks that come with such rapid, aggressive restructuring. The market is waiting to see if the new dual CEO leadership can manage this complexity. For the future outlook, investors face three main scenarios. The bull case relies entirely on the successful and timely execution of the Defense and Security Transformation Plan. If Nuburu closes the key acquisitions, secures the regulatory sign-offs, and begins integrating the revenues from companies like Techne and Orbit, the revenue jump would fundamentally re-rate the stock, making its current market capitalization look drastically undervalued against its projected defense backlog and recurring SaaS revenue potential. The projected $500,000 in billings for Q4 2025 from Nuburu Defense is the first small test of this new business model. The secondary bull catalyst is the blue laser technology finding a killer application within the defense sector, essentially merging the two segments into a single, highly specialized unit. The target market for electronic warfare alone is projected to reach $19.4 billion by 2028, so the potential is certainly there. The bear case centers on two main issues: funding and execution. The company's ongoing need for financing is a constant drag, and further large-scale equity offerings will continue to dilute shareholders. If the acquisitions are delayed, fall through, or fail to generate the projected revenue, the stock price could easily revert to its 52-week low. The defense industry is notoriously competitive, and integrating a SaaS business focused on operational resilience into a legacy laser company is a cultural and logistical nightmare that few management teams can successfully navigate. Finally, the worry case is a return to compliance issues or financial distress. The NYSE compliance problems in the past, including concerns over stockholders' equity, shows the fragility of the balance sheet, which relies heavily on securing new financing and successfully integrating the acquired businesses to generate stable cash flow. The fact that the company has a long history of unprofitability, with net losses in the millions, means the cash runway is perpetually short. So, while the expectation is that this company, with its fancy blue lasers, is now an overnight defense tech success, the reality is that it's a deeply speculative asset whose entire future is riding on a complex, rapid, and heavily debt-financed acquisition spree. The success of this stock will depend less on the brilliance of its core laser science and far more on the management team's ability to be world-class M&A operators and corporate integrators. That's a huge shift in the investment thesis. It's a binary bet: massive re-rating on successful transformation or continued struggle and dilution if the plan falters. Comment below how you weigh the execution risk of these defense acquisitions against the massive potential revenue growth they promise. It is important to remember that this stock remains exceptionally volatile and is subject to significant dilution risk, which is what is keeping its current market value depressed despite the ambitious corporate press. In summary, Nuburu is a high-stakes corporate metamorphosis story. Investors who focus only on the blue laser technology are missing the plot. The only thing that matters now is whether they can successfully transition